price cycle. This is very important because we're getting close to what the algorithm is doing. Basically, the market has 4 phases, 4 stages. Let's check one by one. Let's go one by one. The first one is consolidation. This is number 1. Consolidation. Then number 2, market has expansions. Market will have retracement. And number 4, reversal. And this is the important one, number 4. Okay, these are the 4 stages. Let's make it a little bit. Let's make it bigger. There. Good. Okay. Phase number 1 is consolidation. Phase number 2 is expansion. Phase number 3 is retracement. And phase or stage number 4 is reversal. The market will do this every time. We'll do this every day in all time frames, in all instruments, in all pairs. It will do the same thing, the same work over and over and over again. So once again, I don't want to be annoying, but if you follow the trend, trust me, you will have better results. Let's check this example. Let's check this example, this trade on NCD dollar, NCD USD. As you see, price created a new low. It's breaking lows. It's creating higher lows. And we have a CP level here. Okay, we have a CP level. Good. When we go to the 15-minute time frame, you see that the price, has the 4 stages here. Has all of them. Price did a consolidation right there. Price consolidated here. Okay. Then price expand. See, price expands after the consolidation. Consolidation number 1. We'll do this like this. Number 1, consolidation. Number 2, expansion. This is our number 2 phase. Then it will retrace. It will retrace to the level. Okay. It will retrace to the level which was responsible of creating the expansion. Basically, this level. And this is the important one. This is our important level, our important phase, the reversal. Why the reversal is the most important one? Because it's where we are going to execute our order. This is where we're going to jump into the trade. Here at the reversal phase. When we identify our cycle, here's our reversal phase here. Number 4. This is where your limit order should be placed. Okay? So when we identify our price cycle, we know what's going to happen next. So we have more probabilities. So this is how the price cycle looks. This looks, and this can be found in all time frames, in all pairs. Let me share another setup. Let me show you this setup on gold. And actually, this is a buy signal I sent to the team. Here, we are in a bullish structure. We have a higher high created, price reversed. Okay, price reversed to the level, leaving some inefficiencies in the movement to the downside. So when we go to the 1 hour time frame, there were some interesting stuff here. I'm sorry, the 5 minute time frame. Here. Okay, here it is. You need to train your eye. You need to work on this. You need to do your chart work. to start identifying this and seeing this more often. But if you see here we have, here we have our consolidation. We have an expansion. This is an expansion. Then we have the retracement. So basically the consolidation tells us, after the expansion, where the market is going. That's what the consolidation will tell us. That's what the phase number 1 will do. It will tell us the direction where the market will go after the expansion. The expansion is the sign of where the market is going. So in this case, we had an expansion to the upside. Then the retracement, what the retracement will do? The retracement will fill the inefficiencies that were left. As you can see, we had a gap here. So the market in the retracement phase will try to fill that inefficiency. And then we have our reversal level, which is right where we're trying to get in this candle. Right there. Okay. So we have the consolidation. Then we have the expansion, number 2. The expansion. Then number 3, the retracement, filling inefficiencies or gaps. But most of the time will be inefficiencies. Because, buyers and sellers are completing their transactions right at this price, in this range, in this, let me place a line here. They are doing their business right here, from the 1808 to the 1798. That's where they are doing their transactions. And after that, we have number 4 from our price cycle, the reversal. This is where you're going to place your order. And what happened next? What happened next? See how we are starting to use all the concepts we are learning. The structure, supply and demand levels, valid supply and demand levels, inefficiencies, price cycle, and how all of this in combination works. So when we are in a bullish trend and we have inefficiencies like this, we know the market will try to fill that. And if we have a price cycle, see how much and how we can get higher returns. Right to the inefficiency. That's how you can get almost 1 to 10 risk reward ratio. But actually, it gave us 113.57. This is using 5-minute time frame. You can go lower in the time frame, of course, but I wouldn't recommend it. I feel comfortable using the 5-minute time frame. To me, is the most accurate one. But if you want to go lower into the 1-minute time frame, the 3-minute time frame, you can do so. But be aware that you will have some stops, some stop losses before getting the right one. So that's why I try to use only the 5-minute time frame. So this is how the price cycle works. This is what the algorithm does every day in all markets, in all time frames. And we just need to try to identify in which part of the price cycle we are in. So if we are in number 3 from the price cycle, then we know that the reversal might happen around the consolidation level, and we just need to identify the level responsible of creating the expansion, and that's where we place our trade.